So I'm trying to do more analysis videos on larger cap type of stocks that are actually declined 20, 30, 40, up to 50% from their highs. In the case of 3M, I did 3M, I also did Pfizer, I did many of those other, beaten down stocks that are still pretty close to their 52-week lows. And Home Depot is actually one of those stocks. It's a little bit far from its 52-week low, around $265. There was pretty strong support over there, and then Home Depot bounced, and now it's coming back down and is trading around $291 per share. Now, Home Depot, as you know, they benefited a lot from what we had from the stimulus check and the housing boom in 2020 and in 2021, and even a little bit in 2022. Well, now, as the Fed is raising rates and then, mortgage rates are going up, housing market is slowing down, and Home Depot is starting to feel some pain, and it's a process of reversion to the mean. So in this video, we're going to take a look and see if maybe the market is overreacting on Home Depot, because again, as it's going down, it's trading now, pretty close to where it was trading at in September of 2020. So we're gonna take a second look at Home Depot, do an analysis, do a little bit of a macro thing around their business, their valuation model, and try to determine a very fair price we can buy Home Depot at. So again, I hope you enjoy this video. Now, first of all, starting with the income statement, I have to admit I am very, very impressed with Home Depot's management and how they actually handled the labor situation. By looking at their SG&A, I expected a much higher increase between January 2022 and January of 2023, but the increase wasn't as high as I expected. They still ended up with lower operating incomes than what they had in 2022, but they still did a very good job in actually managing labor costs. They did cut on labor. I also go to Home Depot and Lowe's sometimes, and I see a lot of self-checkout type of things. I rarely see cashiers anymore, maybe one or two, and the rest are actually self-checkout. And this is maybe something that's actually helping Home Depot cut some costs on labor and stuff. But so far they have done very, very well in terms of labor. Their net earnings, they increased slightly, but I believe this is maybe their last quarter where they increase earnings. I think this is coming to an end, and they're going to have a very hard time actually comparing those numbers in 2023 to what they really had in 2022. Now, looking at their guidance actually does include an increase in the hourly around the $1 billion additional annual compensation for the hourly associates. So it's going to reflect again in the margins and stuff into 2023. But they did put in their sales growth and comparable sales guidance, which they expect to be flat compared to their fiscal 2022. And I actually have a very hard time believing that they will only be flat compared to 2022, because if we look at the earnings or revenue growth trend for Home Depot, and we look, they were growing between 2016 to 2019 a pretty sustainable 6 to 7%. In 2020 it was 1.8%. 2021 was massive, around 20%. 2022 was around 14%. This is their fiscal year, so 2023 is actually 2022, and then they grew around 4%. And again, they only expect to be flat for fiscal year of 2023. Now, I have a hard time actually believing this. After they grew 14%, I would expect some type of a bigger decline, like a maybe 2, 3, 4% decline at least, so we can look at it and see that this is a pretty good reversion to the mean. So I believe their earnings will likely surprise to the downside, and they will not be flat in 2023. But that's just my personal opinion, and it also depends on a lot of things like mortgage rates, which I believe the Fed is not going to cut rates in 2023, so they will likely stay elevated. You also have lumber prices, which are pretty volatile, and we look over the past 5-10 years in terms of lumber prices, they're all over the place. So again, this is really affects Home Depot's industry, and especially the high cost of debt, the mortgage rates and stuff. Whenever you have higher mortgage rates, it kind of helps people not really go and buy houses. They try to stay in their own place, and it's the same for the people that actually rent, they actually stay rented instead of trying to buy a house. So it really slows down the demand for lumber. But again, those people that stay in their homes, they will most likely do improvements and then use maybe a little bit of lumber rather than just go and buy a house, because they can't go from a 3% locked in mortgage to around 6 to 7%. So there's a lot of different variables and it's a little bit confusing. But again, this is the story with Home Depot, and higher mortgage rates are actually not good for this company. And I have a hard time believing that it will just go flat. I believe it will most likely decline in 2023, and Home Depot will actually have to revise those numbers. But Home Depot, again, is not only for customers and stuff, it also has a lot to do with businesses and stuff like that. And in 2020, they actually acquired HD Supply, which very, very important, and it was very smart from Home Depot's management to actually acquire, HD Supply. A lot of businesses, hotels, other type of industrial places and recreational places, they use HD Supply to order parts and many other things. And Home Depot bought HD Supply and actually integrated it within their website. And I believe this was very, very smart from the management. And again, I'm a pretty big fan with the management with what they did with the dividend growth, which is, sustained. Many of you like the dividend, the buybacks are pretty great and everything. Now, looking at a basic PE multiple or a forward PE, Home Depot is trading around 18 times forward earnings. And 18 times forward earnings, as we can see, is actually on the lower end of the range. Looking at their 10-year history, it's pretty much as much it was trading at in 2019 and in the March 2020 type of lows. So looking at a historical basis, again, Home Depot does not look expensive on a PE basis. But this is not enough, because again, maybe they will revise those earnings down, as I said, and then the forward PE we could be 20, 22, 23, and we could actually be overpaying, which is why I have my own valuation model to try to determine if Home Depot is a good buy at those prices or not. And taking a quick look at my valuation model, I used 157 billion of revenue, which was they had. I used their 0%, revenue growth, which I believe is going to be negative, but let's assume on 0%. And then I used 4% sustained over the next 4 years. And this is what the analysts have. They have 3 to 3.5%. So I used 4% as housing normally lags effect, so it could last till 2024, even into 2025 in terms of a more of a slowdown, in my personal opinion. And again, 4% is fair. And I think you guys can agree with me on this. Their net income margin is currently 10.5%. I left it at 10.5%. Their PE ratio now is 18. And we talked about a mean PE ratio of 20. So I used the mean PE ratio of 20. Now, using this whole thing and adding a 4% dividend, which is not a dividend, it's 2.5% dividend and around 1.5% in terms of the company buying back around 1.5% of its stock every single year, which the company has been doing. So adding 4% to the equation and using the 20 PE ratio, we actually get 48% on the upside over the next 5 years, or around 9% compounded every single year for the next 5 years. Now, this is, again, actually not bad at all, with Home Depot. But to me personally, Home Depot is actually not a buy at those prices, with all the uncertainty around, the real estate market, which could lag much, much more. Housing starting to come down, things are cooling off. Home Depot could likely, revise their numbers lower. If they said a decline of, maybe 2 to 3% or a 5% decline after we had such massive revenue growth, which they never experienced, I would be more confident to actually invest in Home Depot and see that maybe the worst is actually priced in. But looking at their guidance of just flat, in my opinion, there's a lot that can go wrong with Home Depot. Therefore, I am not buying Home Depot at such prices. Now, my valuation models tell me that if I want to get a double on my money over the next 5 years, I have to buy Home Depot around $223 per share. And again, $223 per share is pretty close to what it was pretty much before the March 2020 crash. So it might, never go there, and I might miss on the upside, but I'm fine with that, as there's over, 8 or 9,000 stocks. I can find any stock I want and then just research it. I'm sure I'm gonna find a better opportunity. But Home Depot is not a buy for me. If I was forced to buy Home Depot, I would buy it. I mean, again, see if it holds 265, and then if it holds 265, maybe I buy it there. But again, I would not be buying Home Depot, in my opinion, above 220 or 230, for the maximum to be on the safe side with everything that's happening. So again, thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.